And right now we turned bullish on gold. There are things going on out there that are far more disastrous. Our expectation is this. We probably have to go to $200 silver. We're going to go to...
I think silver's about to explode. And gold? It's not far behind. That's not a headline. That's Michael Oliver's latest warning. A price tsunami in silver is forming, and once it hits, it won't just move the market, it'll shock it. If you own precious metals or are even thinking about it, this video is not optional. The moment of truth for gold, silver, and your financial future might be closer than anyone expects. Watch till the end, because what Michael reveals could change everything.
We look at all four major asset categories. We don't just, put blindfolds on and look at, let's say, stock market, bond market, gold, silver, commodities, emphasis gold and silver, by the way. Stock markets, S, put an S on the end of that, not just U.S. Bond market and foreign exchange. And it's important because, especially now, I think more so than any time in my experience, which goes back to the mid-1970s, but I got in the future side of the business entity of Hutton. The impact of one asset group to another is more important. It's more impactful. And what we've seen, even since, well, for example, this year, you started out the year, gold rose from January through April, surged upward and paused in mid-April. And what did the stock market do during the first part of the year through mid-April? Collapsed. So, the total opposites there. And then it rallied off the April low. Gold paused. You would think, well, if gold's opposite S&P, S&P went down hard, it went up hard, then therefore gold should go down when S&P goes up, right? Well, it didn't do it. Instead, it went to sleep, comatose, 4 months. That is not the way gold market ever tops. When it tops, it tops. You go back to 2011, the 2015 low, 1980 high. I mean, it's an isolated peak and you collapse. When you go to sleep in gold 4 months, while the stock market is sucking its money back in, instead of it flowing into the alternative of gold. But instead, there was demand for gold anyway. There were sellers all for that 4 months. And yet it wouldn't break. You get these sharp little drops and then boop, right back up.
Yeah.
Stock market, we think, is making a major top. I think it began in January. The fact that you made new highs recently, marginal, by the way, we're talking 3-4% above the highs of last year or early this year. That, as it tops, money flows elsewhere. It's never the case when money flows out of everything. You go back and look through his big stock bear markets. No, everything didn't go down. Certain things went up. The two things that went up most obviously were T-bonds, up in price, down in yields, long-term T-bonds and gold related. This is the stock. The gold has already been underway for 10 years upside. It has major cycle. And what they're really dependent on is not some headline here or there or some market here, but on the overall onward decay in the money unit, the dollar.
Right.
I don't mean the dollar versus the euro or the yen. I'm talking about the dollar's real buying power. So when I was a kid, a loaf of bread was 20 cents. Okay, it's not. Look, it's because of the decay in the dollar, not because of increase in bread price. The real value of the dollar, you lose, it increases in quantity, M2, for example, almost doubles every decade. Huge, almost doubles every decade. The population doesn't double every decade. But anyway, and now recently, the last 10, 15 years, it's gone up even more steeply. You look at an M2 chart from Federal Reserve and you'll see it. Well, right. So naturally, prices of things go up because the value of the dollar goes down in real buying terms. It takes more dollars. So people that cheer, for example, the stock markets, it's stock market, got to be there. It's always making money. Go back 25 years, throw a dart, July of 25 years ago, the July 2000, S&P's more than tripled since then at current price levels. More than tripled. Sounds good, huh? Gold's gone up 11-fold. Okay, 11-fold.
Right.
Okay.
Right.
Now, if you flinch return, no, you didn't get the 11-fold gain, but it's gone up 11-fold with definable bear markets in between that we've defined. And right now we turned bullish on gold in February 2016, 2.5 months off the bear low, which was 1,050. Right now we're 3,400 area. Nothing since then in that 10-year period has altered our annual momentum trend analysis of gold. And that's what do we mean by that? It's when you measure gold monthly action, monthly bars, like a price chart, but we measure them versus a 3-year average or 36 month, and we plot them as an oscillator, meaning, okay, this month's high, low, and close are how much above or how much below that changing average. And it ends up, you have an oscillator. It goes above the zero line, it goes below it in bear market, etc. Nothing structural in terms of defining the trend on momentum is even threat right now in terms of breakage, downside breakage.
Okay.
We see all the evidence here that this pause in gold, 4 months, total boredom, is about to launch again. And it probably will launch next month, my best guess. Now, look what's uniquely happened, though, in the last 4 months. While gold has gone sideways and yawning, not going down, but sideways.
Yep.
Silver's gone up explosively. We've gone from the upper 20s to the upper 30s in that 4 month period. And if you look at GDX, for example, it's risen sharply as well, while gold stood still. So it used to be the other way around for the last several years. Since that 2020 upshot we had in gold, the miners and silver, they peaked basically in mid 2020. Gold had a range bound situation, 20% to high low, but silver and the miners tended to retreat more. We're arduous, they get nice rallies, but it'd be a zigzag to the downside while gold went side. That is shifted. It's shifted in the last several months, especially since April, where the miners, if you plot them as a spread, meaning you divide the price of GDX into gold ounce, express it as a percentage, and plot that chart.
Yeah,
and you'll see that it's broken out over trend structures that are easily defined when you plot that spread. Downtrends, horizontal lines, etc. So, and the same with silver. So what it argues to us is that, okay, now we're about to enter, we've entered the phase where those parts of the monetary metals complex will lead gold. This has happened before, and usually when it happens, it's quite dramatic. In fact, if you go back and look at that bull market 2001 to 2011, 2010, silver went vertical while gold continued up, but silver exploded geometrically.
Right.
And we're at that phase now. In fact, if you even just look at a price chart of silver, any of your watchers, just go look on your quote screen and get a silver futures continuation chart, meaning it rotates to the next active contract here. Go back to the 2022 low. Remember that low? That's when we paused from 2020, 2021, and we flushed in gold. It took it from like $2,000 down to $1,620. Well, silver also went down then. Made a low. Miners, same story. If you plot the action since 2022 low, which would have been like August, September, you could plot a parallel uptrend channel on price. You've emerged through the top. Yeah, an upward bull market, but at a definable angle of recurring rallies and lows that just stay in the tube, and frustrate because you get these sell-offs in the tube, but it's still rising. They forget to see that. We've blown through the top of that. We did that about a month ago. And after doing it, we've paused, but we're above the channel top and comfortably quiet. So we've had a breakout, even evident on price, much less momentum, which already broke out before that. So I think we're headed to, pardon me, my camera is moving. I think silver's has entered now that acceleration phase. Our expectation is this. It's now outlanded. The $50 highs we saw in 1980 and 2011 in silver. Think about how much time has passed. Well, the decay in the money, even since 2011, has been enormous. Yeah. So even just to get back to 50 isn't getting back to 50 in real dollar terms. We probably have to go to $200 silver just to match the 1980 peak, at $50. Okay.
Right.
I think we're going to go to $60 to $70. There was below the $50 highs, what I call idiot highs, because they really don't mean too much, especially in real terms. And do that this year in this surge that we've now commenced.
This year?
This year, meaning in the next 5 months. There might be a pause there. I'm not sure. But I think at least we're going to blow out the 50 and not even pause till we're credibly beyond it. Now, is that the end? No. We're in a different situation. I think you know it. Eric Sprott knows it. A lot of people know it. This isn't just another gold, silver bull market. This isn't just 1980 and then it's over and you go down to hell for the next couple of years, or 2011 and you go down to 2000. There are things going on out there that are far more disastrous, pending and already commenced, that will impact monetary metals. We don't call them precious metals. Platinum's a precious metal. Gold is a monetary metal. And that is that when that shit hits the fan, pardon me, you have to edit that out. Central banks will go more berserk than they have ever been, because not only will stock market go down, but all the data points they like to chatter about, how, job market's looking good, which it really isn't when you look at the inside data. But once the market starts down, if you go back and look at the 2000 top, 2002 low, 2007 top, 2009, all the data points that they like to chatter about really started to go south in an obvious way once the stock market topped
Yeah.
and started down, and finally people started pulling their hair, and there were the CEO says to don't hire any more employees this month, we're on pause, or lay them off, and all of a sudden the data points will shift. That's when the central banks will go ape, and they always do. They always do. If you go back and look at those two tops, you'll see they started cutting rates like crazy. It didn't help the stock. What helped? Two markets went up during that time: gold and T-bond. Question now is T. You mentioned that.
Yeah, please.
Yeah. Well, the T-bonds, they're not responding to the Fed. They usually don't, because it's the long end of the debt market. We're talking 30-year T-bond future, not the 90-day stuff. When the Fed cuts rates like they did, back late last year, a couple times, took it off the high, the recent high, shallow high by the terms of rates, historic. T-bonds went down in price, up in yield, despite them cutting. And if you look at a T-bond futures chart or a yield chart, which is the opposite, they're clustered. T-bond prices are just laying on the floor, anemic looking, despite even during that drop in April in the stock market. Didn't help the bond market. They tried to go up in price. There was a nice rally into early April, but then they collapsed. And they're just laying here a point or two off the floor of the last actually several years. So the long-term rates are choking, and they're not letting loose. The noose is not getting looser. It's just as tight as it was 2 years ago, which means there's a lot of big corporations, especially commercial real estate, and plus the government is hurting because of this. So we don't just have a mortgage problem like we did in 2007 to 9. Now suddenly it's government debt. We all know that there's credit card excesses, by the consumer. They're at their limits. They're past due. We also know there's a lot of late filing of taxes now, increased sharply. People just can't pay it, so they delay or they try to set up a plan. Something's hurting already. But when it becomes bleeding obvious to the central banks, gold already knows this is going to happen. Mm-hmm. That's why it's not sitting and waiting for the bad data points for the Fed to cut. It's already on its way. It knows. And not just the U.S., but the Japanese have been doing it, and we know the EU will. So that's the dynamite. So we watch the stock market because it's going to have an impact on the central banks, but also money flow. If people get out of the stock market, they go somewhere, and they usually go to those two things. But if you're a portfolio manager and you're looking at gold and T-bonds ain't working. Only gold's been working. Gold's up, despite the pause, is up a lot more than the stock market this year, the last 3 years, the last 10 years. You go back to 2015. Gold's beating, anyway.
If this gave you chills, good, you're paying attention. Michael Oliver just gave you the blueprint before the storm. Now it's on you to act. So hit that like button if you value the truth, subscribe for more critical insights, and don't forget to tap the bell icon. Because when the tsunami hits, you'll want to be on the right side of the wave.